Hello. Um, Hello, Mr. Kindness. I hope you are here. Sorry that we're starting late. Um, so if you can just see my screen, I think you can just write on the chat box that you can see my screen. You can see section 8. FCA online video lecture.
Yes, please, guys. We can see your screen.
Oh, okay, good. Okay. So today we'll be talking about sorry, we'll be talking about partnership. But before then, I'm sure that you know the class rules of this online class, and because you are behind the schedule, we just move straight to this course. So we'll be talking about partnership business and what is partnership account itself. So partnership is actually a type of a business structure. It's a business that consists of two or more persons coming together to carry on the business with a view of making profits. So a partnership cannot exist in the first place if they don't have the intention of making profit. So the basic aim of a partnership business is to make profit. There are several features of partnership. It must be an association of two or more persons coming together, and that is what differentiates it from a sole proprietorship. There also must be an agreement entered into by all persons concerned, and there must also be an agreement to share profits or loss of a business, and the business must be carried by all or any person concerned in acting for. So there are also type of partners in partnership account itself. We have the active partner, we have the sleeping partners, we have partners by Estupel, we have nominal partner. There's several various type of partners in partnership accounts. Active partner is where the partners is active in managing the business and partaking day-to-day running of the business itself. While sleeping partner, on the other hand, is actually where the partners is actually does not participate in the day-to-day running of the business. It does not participate in the running of the business. Also, we have secret partner. This is a situation whereby the partner does not want his identity to be known into the business. We also have partner by Estupel. This is a situation whereby the partners come together to say a good thing about a particular business, and because of the trust people have for such person, people honor his word and patronize the business itself. So that is what partner by Estupel is. We have nominal partner, whereby this partner does not contribute any money into the business except for his goodwill. We have partners by profit. This type of partner is only interested in the profit of the business. He does not partake in day-to-day running. He does not partake. He does not want to hear anything except for the profit of the business itself. So that is partnership account, and we have several reasons why we can have change of in partnership business itself. Maybe we have additional partners that is coming into the business. We have a partner that wants to retire, or how do I put it now, or debt of the partners, and so on and so forth. We'll discuss that as we move on gradually into the class. So partnership accounts is actually divided into two different parts. We have the capital account and the current account. The capital account is usually specified that each part of what each partner actually contributes into the capital. So it's like a fixed capital that cannot be touched in this business, and it is expected that partners should not touch this type of business when contributing it in their businesses. On the other hand, current account is used to accumulate profit. That is where all the profit that has been earned by the business is being gathered into and put into. And this type of current account is where also partners can actually withdraw personal money for personal use. This type of current account is used to record the accumulated profit of the partners and the partners' drawings. So without further ado, so we have partnership is actually like current accounts is actually something like an equity that is a credit balancing account. So it's like how we open your capital is also the same similar way on how you open your current account. They are both a credit balancing account. So what is profit sharing ratio? Profit sharing ratio itself, because the main purpose of this partnership business is because they want to share profits, and there must be a ratio, a profit sharing ratio for this, in order to, an agreed profit sharing ratio for this, in order they can move on. However, if the question is silent and there's no particular profit sharing ratio in this type of partnership, or there's no agreed, they didn't discuss it prior to the business, it is said that all parties should be shared, all profits should be shared equally. So there should be an agreed percentage in when sharing the partnership business. However, there can be also some condition even before sharing their business profit itself, and that is the situation whereby we have a national salary and a national interest on long term. Hence, what is national salary? National salary is salary that is paid to a partner. So once they agree that a salary should be paid to a particular partner, it's still similar to the salary we pay workers itself. But this time around, since they are paying it to a particular partner, so it is called national salary. Also, you have national interest on long-term capital. So there are some capital that are actually acquired with interest, and the partners need to be collecting interest. So in a situation whereby you have national interest, you have national salary, and you also have profit. So the intention is that national salary needs to be deducted first from your salary, then go by national interest, then followed by your profit sharing ratio. In some questions, they might not call it profit sharing ratio and give it an abbreviation of PSR. So for example, the illustration we have below, we said the WXY partnership has three partners, WX and Y, which share profit and losses in an agreed ratio of 358. So in other words, I said 3 is for W, 5 is for X, and 8 is for Y. So then how do we share profit for the year that is 1.92 million? So it is said that we will have okay, great. So in this situation, we will have 3 over 16 times 1.92 thousand million, which will give you 360,000 for W. We have for Y that 5 over 16 times 1,920,000, which will give you 600, and we have for Y. So that is how to calculate your partnership business itself. Make sure that you add all the ratios together and start looking for the fraction of each particular partners. Hence, at the end of the day, the addition of these three must give you the profit sharing figure itself. What is notional salary? As I explained earlier, this is an agreed amount that is different. The partnership agreement might recognize a different amount of work done by the partners by awarding one or more of the partners with a notional salary. Notional salary is an agreed amount awarded to individual from the partnership profits. Now note, it is from the partnership profits. It is not before the partnership profits. So it is where the partnership has also it is after they have profit for the year that a notional salary can actually be paid. So that is notional salary. Also, we have notional interest on a long term. The partnership agreement might also provide for partners to obtain national interest on the long-term capital they have invested in the business. Like I said earlier, that there are some business, there are some capital that is being issued or given or invested by the partners that actually is entitled to notional interest on long term. So notional interest on long-term capital is not an interest expense because the capital in the partner's capital account is equity and not a liability. So let's look at an example and maybe we get a clearer picture with this. Okay, so partner DEF has three partners, D, E, and F. Partner D contributed 100,000 of fixed capital. Partner E contributed 120,000, and partners F contributed 60,000. The agreed profit sharing ratio was in the following way. Now note, partner D to receive a salary of 4,000 and partner F a salary of 7,000. All partners receive interest of 5% at 5% on fixed capital contributed. Residual profit or loss to be shared between D and F in a ratio of 3:5. The profit of partnership for the year is 95,000. Just note that this 95,000, that's the profit for the year. The partner profit would be shared between the partners as follows. Now look at it. Like I said, if you have in a situation whereby you have notional salary, notional interest, and you have your profit sharing itself, the one that comes first is your notional salary, followed by your notional interest, and followed by your profit sharing ratio. So that is it. We also, so for the national salary, we have 4,000 and 7,000 naira. And for national interest at 5%, we have 5,000 naira, 6,000 naira, and 3,000. How did they get this national salary? The national interest. National salary is already given in the question. There's no two ways about it. It's always been given. 4,000 and 7,000 for partner D and partner F itself. And for partners that receive interest, all three partners receive interest at 5% on the fixed capital contributed. So what is the capital contributed? D contributed 100,000. So what is 5% of 100,000 is 5,000. E contributed 120,000. What is 5% of that? 6,000. And partner F contributed 60,000. And what is 5% of that? 30,000. So that was how they came about this 30 figure of notional interest. Now note, it is the addition of this notional interest and your notional salary less it from the profit for the year, because note that your notional salary and your notional interest is always removed from your profit for the year, the partnership profit for the year. So it is the difference between the notional salary and the addition between notional salary and notional interest minus the profit for the year is now what they will actually contributed. So if you add 11,000 and 14,000 together, it's going to give you 25,000. If you subtract 25,000 from 95,000, it's going to give you 70,000. That was how they came about the 70,000 for their residual profit sharing. And guess what? What is the profit sharing? It says 3 to D, 5 to E, and 2 to F. So 3 plus 5 plus 2 makes 10, and that is how they got 3 over 10, 5 over 10, and 2 over 10. And by the time you got your formula, you see 3 over 10 of 70,000 will give you 21, 35, 14 respectively. And then you add everything together. So at the end of the day, at your sharing profit, at the end of the day, your answer must still give you the total profit for the year, which is 95,000. It's straight up and that's easy. So you can look into this question. Practice question for GHI, and also not actually different from the illustration we gave. The profit for the partnership for the year is 1.146,000. Partnership G has contributed 500 fixed capital, each 400 and I 300. All partners, excuse me, all partners have agreed to share profit in the following way, as it is. Partner H should receive a salary of 50,000, I salary of 100,000. All three partners should receive an interest of 8% fixed capital contributed. Now, note there are some notional interest that is not necessarily that all notional interest must be attributed to all partners. We are just being lucky that the question is saying all three partners or all partners should receive a notional interest. So you just need to pay attention to details on some of the question, because it's not necessarily that it's all the partners that are actually getting notional interest. And we have residual profits sharing to be 3-2-1. It's as easy as follows. Did they give us our profit for the year? Yes, 1.114. So you can try that. It's actually not different from what the example we just saw. To still catch up with our time, we also have another condition in profit sharing ratio, whereby we have guaranteed minimum profit share. Guaranteed minimum profit share. So for example, a partner agreement might agree a minimum profit share or for one or more of the partners, as the case may be anyway. Now, what they are literally telling us is that, for example, let's come back to this illustration first. Then, for example, they can tell us that the minimum amount that D should be collecting should not be less than 35,000. And guess what? In this case, D is collecting 30,000. But because they've agreed that the least amount that D should be collecting is 35,000, then the difference between the 30 and 5 will be shared between the rest of the partners. I don't know if that makes sense. And this amount will be less from the partners and will be added to this account. Okay, let's look at an illustration if it will actually make a whole lot of sense. The XYZ partnership has 3 partners, X, Y, and Z. The partnership agreement provides for partner X to receive a national salary of 20,000 and residual profit or loss are shared between X, Y, and Z in ratio of 2, 4, and 6. In addition, the agreement guarantees a minimum profit of 32,000 to partner Y. The partnership profits for the current year is 80,000 naira. Then how will they share this profit? Note, in addition, the agreement guaranteed a minimum profit share of 32,000 to partner Y. So what the question is literally telling us is that partner Y should not collect anything less than 32,000 naira. If it is more than 32, it's fine. But if it is less than 32, it's not fine. Okay, so we have notional salary comes first. What's our notional salary? 20,000 to only X. And we have the difference between the 20,000 and the 80,000 is 60,000, which is how they got their 60,000. And then we share the profit normally to everybody to see if partner Y will be entitled to 32,000 naira. And at the end of the day, X is entitled to 30,000 naira, Y is entitled to 20,000 naira, and Z is entitled to 30,000 naira. But what was the agreement? Y should not go away with anything less than 32,000 naira. So the difference between 20,000 naira and 32,000 naira is what will be shared between X and Y and deducted from their accounts respectively and added to Y's account. Hence, we have the difference of 12,000 naira. And since X has a profit sharing of 2, Z has a profit sharing of 6, then we have 6 plus 2 making 8, and they shared it amidst themselves. So let's go with his 30,000 naira, we reduce 3,000 naira from it, and it goes on from 30,000 naira to 27,000 naira. Z also, from his 30,000 naira, we reduce 9,000 naira from it, and here goes on with 21,000 naira. Then the 9,000 and 3,000 naira is added back to Y, so that Y we collect 32,000 naira. That is it for a guaranteed minimum profit share. So back to our changes in partners. We have change in partnership business itself. So there are situations, like I said earlier on, that partnership accounts can cause. And some situation whereby it can cause partnership, like I said earlier on, the retirement, the addition and amalgamation of a new partners, addition of a new partners, the death of a partners, or the retirement of partners. So the agreement on how the partners should share the profit of the business may be changed during the financial year. When this happens, the total profit for the year should be apportioned on time basis. 1. Profit of the business during the time of the old profit ratio arrangement, and profit of the business during the time of the new profit arrangement. That is, if the partnership occurs during the year. Anyways, let's look at an illustration to make it clear. Partner DEF has 3 partners, D, E, and F. The first half of the year, that is 1st to June 30th, partner D and partner F had received annual salary of 30,000 naira. That is notional salary anyways. Residual profit or loss are shared between D, E, and F in ratio 3:5:2. There is no interest on capital. In the second half of the year, from 1st July to 31st December, partner D salary was increased to 40,000, and the partner altered the profit sharing ratio to 1:1. Sorry. The salary of partner F was unchanged. The profit of the year was 220,000. The annual profit would be shared as follows. So what happened in the first 6 months? The first 6 months, they said their national salary is 30,000 naira annual. The annual salary is supposed to be 30,000 naira each. But then for the first 6 months, it means that they must have collected half of the 30,000 naira, which is 15,000 naira. Or the better ways to do it is that if your annual salary is 30,000 naira, can you divide 30 from 12? And the figure is going to give us, you multiply it to 16, and which is what gave us 15,000 naira. That was how they got 15,000 naira each. It's not as if they divide 30,000 naira divided by 2 because D and F is sharing 30,000 naira. No, each of them collected 30,000 naira. And because it is still half of the year, how much have they collected so far? It is 15,000 naira, 15,000 naira each. Hence, they have a profit for the half of that year was how much? the residual profit or loss should, the residual profit or loss ratio should be 352. There is no interest or capital. The profit for the year was 220, arising evenly. Look at the quotes here. It says arising evenly throughout the year. So what they are saying is that if you divide 220 divided by 12, that is the amount that each month actually contributed. That's the profit that each month actually earned. So the amount was evenly earned in the profit for the year. So what is 220 divided by 12? So calculator here. So 220,000 divided by 12 is going to give you 18,33333. But if you multiply it by 6, what is going to give us? It's going to give us 110,000 naira. So for the first 6 months, they earn 110,000 naira. But then out of that 110,000 naira, 30,000 naira have been paid as notional salary. So how much is left? We are left with 80,000 naira. Then the old sharing profit ratio was 3, 5, and 2. So that's how we have 3/10, 5/10, and 2/10. And we got our figures: 24 for D, 40 for E, and 16 for F. So for the first 6 months, D went away with 39,000, E 40,000, and F 31,000. And after that, something changed. They changed this annual salary of D, while F remains unchanged, and they changed the profit sharing ratio. So what was now the annual salary of D? The new annual salary was increased from 30,000 naira to 40,000 naira. And if his annual salary was increased to 40,000 naira, then for the second half of the year, he will be collecting 20,000 naira because it has already increased. And that was how we got a national salary of 20,000 naira. Then F was unchanged, so we have 15,000 naira. So for this second 6 months, then the national salary for both of them was 35,000 naira. And the difference between the amount of national salary and the profit is what the three of them will share, that their new profit sharing formula. 35 minus 110,000 is going to give you 75,000, and they share it accordingly to 1:3:1 ratio. So in the second half of the year, D went away with 35,000, E 45,000, and F 30,000. So total amount is 74,000, 85,000, 61,000 for D, E, and F respectively. So partnership is that straightforward and easy to assimilate if you just pay attention to the question. And we move. So in our current account, like I said, our current account shows profit, joins, and sorry. Our current account shows profit, joins, and the partner's current account itself. And for the profit each year, for each partner, the share of the annual profit is added to partner's current account, and any join is also deducted from this current account itself. So let's look at the example. There are 3 partners in the ABC partnership, A, B, and C. The capital and current accounts for the partners at the beginning of the year were as follows. Partner A has 100,000, B, 100,000 worth of capital, 200,000 for partner B, and 160,000 naira for partner C. The current accounts for partner A is 60,000, 40,000 for partner B, and 8,000 naira for partner C for their current account. The profit for the year is 103,000 naira. The profit sharing agreement was that partner A is given a salary of 17,000 naira, partner C has a salary of 15,000 naira, and the partners pays themselves interest or capital of 5% per year. The residual profit or loss is shared between partner ABC in ratio 1:3:2. In addition, during the year, drawings of each partners were 20,000, 25,000, and 40,000 for partner A, B, and C, respectively. Then, how is the drawing profit sharing going to look like? Remember, how we solve our notional salary, notional interest, and residual value. So straightforward, like the way we have always been solving it. And at the end of the day, for this question, A goes home with 30,000, B with 34,000, and C with 39,000. But note that there was a joint in the course of this year, and which now leads us to open a current account itself. So in the current account, we have balance BD of 6,000, 6,000, 3,000, and 8,000. How do we get this 6,000, 3,000, and 8,000 in the first place? Remember, the current account is 6,000, 3,000, and 8,000. So that was how it was being got. The profit share was 30,000, 30,000, 34,000, and 39,000. Remember the drawings. The drawings was 20,000, 25,000, and 40,000, which was how they got it in this place. So the difference between your credit side and your debit side is what we have as balance carried down of 16,000, 12,000, 7,000 for partner A, B, and C, respectively. So this is also another method. Anyway, the current account can also be set out in the column method. Beginning of the year, we have this amount, add share of profit of 30, 34, and 39 that we solved. 30, 34, and 39. Then deduct your drawings, and the difference is going to be end of the year amounts 16,000, 12,000, and 7,000 respectively. 16, 12, and 7,000. And then we officially go into the change in partnerships itself. Which is the main account. So change in partnership. We have reasons for this change in partnership. We have the goodwill part, accounting for the change in partners, admitting a new partner, and retirement or death of a partner. And the retirement or death of a partner. A partnership might change due to the following. We've said this before. The accounting problems are similar to each cases. Though amalgamation does not have an extra dimension, which will be discussed later anyway. In each case, the old partnership comes to an end and the new partnership is formed. Usually, the record of the old partnership continues as those of the new partnership, with adjustments to reflect the change of ownership. The main objective of this adjustment is to establish the capital of each partner in the old partnership. The importance of this is important in each of the above cases. So we have admission of new partners, we have retirement, and you can actually read that. But let's look at an illustration and so we can move in as fast as possible. So Ayobola and Caleb were in partnership, sharing profits or loss equally. The firm bought a plot of land in 2001 for 250,000 naira. Ayo left the partnership on 30th June 2013. The land was worth 4 million naira at that date. This is also known as fair value. The land has risen in value by 1.5 million. How did they get this 1.5 million? The difference between this 2,500 and 4 million is what the land has risen by, which is 1.5 million. But this is not reflected in the financial statement. This means that your capital does not include a share of gain, but clearly 500,000 of the gain belongs to him. And how did you get 500,000? Remember, they are supposed to share the profit or loss equally. So this is Ayo, this is Bola, and this is Caleb. 1/3 of 1.5, 1/3 of 1.5, 1/3 of 1.5 gives us 500,000 for Ayo, Bola, and Caleb each. So the amount at which this land has been raising is for Ayo and Bola and Caleb to be shared among, which is 500,000 naira each. Somehow the extra amounts must be accounted for so that Ayo can benefit from this. So another illustration is Adebolu and Kola were in partnership sharing profits issue equally. Ade left the partnership in 30th June 2013. Why are they leaving in 2013? At this date, the net assets of the firm were 6 million. The value of the firm was estimated at 9 million naira. And this difference between the fair value and what they have in their book is 3,000 naira. And this 3,000 naira is called goodwill. And this will be Ade shared the net assets. Ade's shares of the net assets might be 2 million naira, but his share of the value of the firm is 3 million naira. How did they get this 3 million naira? Remember, they are to share this their profit or loss equally. And they have 3 million naira increase. Ade has 3 million naira. So how much is Ade's portion in this 3 million naira? That is 1/3 times 3 million, which is 1 million naira. And they said Ade's share in net profit is 2 million naira already. So with the existing increase in net asset of 1 million naira to Ade should be entitled to 3 3 million naira as extra amount. So the problem, this illustration and this illustration is actually not actually a difference. Goodwill is an amount by which the value of a business exceeds the value of its net assets. Goodwill is an intangible asset of the business, but normally it is not recognized as an asset in the financial statements. Then how do we treat goodwill in partnership business? So the value of a firm is X and less the assets, less it from the liability, and to get your net assets, then less it, the difference between the value of a firm and your net assets is going to give you goodwill. This is a typical illustration of goodwill. A firm has a net asset of 1 million naira. One of the assets held by the firm is a property at cost less accumulated depreciation of 400,000 naira. The property has a market value of 600,000 naira, 200,000 above its book value. The firm is valued at 1.8 million. So there are two ways of calculating this. It is either you are using revaluation account method or you are using depreciation method alone without revaluing the assets. Now, what is the value of the firm? Generally, the value of the firm is 1.8 million. And if you are using without revaluing the firm, then your net assets will be 1 million naira. 1.8 minus 1 million naira will give you 800,000. But if you are using a fair value or evaluation method itself, then the assets less liability, fair value was, where is it again? Was 1 million. Remember, this was 1 million. And at the same time, then I said the market value, the property has a market value of 600,000 naira. So there's a property in this asset itself that is valued at 600,000 naira. So that is 200. They now say 200,000 above the book value. So it means that it's 400,000 that is in this book, this figure, as property. Meanwhile, when they revalue it, the 400,000 that is in this figure is saying that should be 600,000. So if you remove 400,000 and add 600,000, it's going to give us 1.2. Or you just add the 200,000 out to this 1 million. It's going to give you 1.2. And the 1.2 is now the new fair value, which is still less than the value of the firm. So the difference between the value of the firm and the net assets at fair value is known as goodwill. So accounting for change in partnership. So we debit goodwill because goodwill is an asset, and we credit partners capital. Admitting a new partner. Oops. When admitting, sorry, the light just went off. I'm very sorry, but can you still see my screen? Okay, wait, we're back for live. Sorry about that. So admitting new partners. When a new partners is being admitted, the following step need to be measured. Measure of goodwill of the old partnership, recognize the goodwill sharing, and remove the goodwill from the books, and account for the capital introduced by the new partner. So when a partner is retiring, almost similar case, but just an additional one. Measure the goodwill, recognize the goodwill sharing, remove the goodwill from the books, and account for the capital taken. Here, we account for the capital introduced because we are admitting a new partner. Here, we are accounting for the capital taken because we are letting go of a particular partner. Just note that's the only difference. So we can have amalgamation of a partner, we can have dissolution of a partner too. Amalgamation is when two or more partnership business actually combine together. While dissolution is when partnership are actually being dissolved and they want to go into their separate ways. So you may have to construct. Okay. So the statements of financial position. Let's look if this is an illustration. The statement of financial position is the statement of financial position of each business immediately prior to amalgamation and before any of the necessary amalgamation adjusted were as follows: AB and Co, CD and Co for non-current assets and for their current assets. So at the end of the day, when you are merging them together, you are just adding these two figures together to get your total the total worth of the business, the new total worth of the business. The solution of a partner. So a partnership might be ceasing trading. When this happens, the partners are said to dissolve their partnership and liquidate the firm. The following step must happen. Some assets of the firm are sold at profit or loss, which must be shared also by the partners. Other assets might be taken by the partners and part in settlement of their capital. Liabilities are paid, though some might not be accepted by the partners, thus increasing its capital. So it depends on the nature of the liability, that some might actually not be accepted by the partners. It depends. And finally, the balance of the capital owed to the partners is being paid off. And we look at realization account. Realization account is accounts used to calculate disposal of an asset or the evaluation of an asset as it may be. So we have realization accounts, we have non-current as accounts, inventory, receivables, cost of dissolution. We have proceeds from selling an asset taking. So it's not necessarily has to be proceeds, it could be the evaluation of a new asset. So let's look at this illustration. Okay. Let's look at this illustration. Yerima and Boluke have been friends for some time, and they both had different business and sole trader, and decided to form a partnership with effect from May 1st to 2017. The respective financial position are this that you are seeing. For the purpose of partnership formation, the following agreements were reached. Premises were revalued to 30 million for Yerima and was to be used for office annex. The equipment value at 3 million naira was counted as obsolete. Some of the customers were found unable to pay their outstanding debt. Therefore, 2 million should be written off. The payables were paid out of the bank balance. Other assets were brought in at book value. These are the conditions for Yerima. For Boluke, he agreed to acquire out of his private resources additional equipment costing 3 million to pay his payables from his bank balance. He pay his loan by himself and bring in other assets at book value. Require prepare a statement of financial position of Yerima and Buluke. State 10 provision that should be contained in partnership agreements. So we have premises to be 70,000 there, office equipment to be okay. This is our solution anyway. Our office equipment to be 30,000 naira. But what did they do? How did they get this figure? Because from our question, if you look at it, how much is our premises? 20,000. We have 40,000 as our for Buluke's premises. At the end of the day, they said premises were revalued for Yerima. So this 20,000 naira was revalued to 30,000 naira. So if we come here and look at our evaluation account, you see the difference of that 10,000 naira here that was revalued as premises. It also states that 30 million naira from office equipment of Yerima was also obsolete. So in other words, out of 10 million naira of Yerima's office equipment, 3 million worth of office equipment is actually not good. So we will deduct 3 million naira from this 10 million naira. It's going to give us 7 million. So 7 million plus 20, sorry, it's going to give us 7 million. I think that was the reason for this 3 million on the credit side. Do you have the corresponding entry? No, we don't have the corresponding entry. Also, and lastly, the 2 million naira that was gone obsolete for bad debts from the receivables of 10 million. So 2 million naira was gone as bad debts and receivables for Yerima now drops to 8 million. Remember, premises is now 30 million. Office equipment is now 7 million because of the 3 million that is obsolete. Our inventory remains the same. Receivables is now 8 million naira because of the 22 million naira bad debts. The payables were paid out of the bank balances. So he has a payable of 500,000 and he has bank of 5 million naira. So if he pays 500,000 naira from the bank, he'll be left with what? 4,500 naira, and his cash remains the same. That's that for Yerima. Can we look at Buluke? Buluke own is that he has acquired, he agreed to acquire out of his private resource. Sorry, am I reading the same question? Okay, yeah. Out of his private resources, additional equipment costing 3 million naira. So from his existing 20 million, he said he wants to acquire another additional 3 million naira, making 23,000 million naira worth of office equipment for Bolukemi. He said he wants to pay his payable also in his bank balance like Yerima. So he has a payable of 1.2 and he has a bank balance of 10 million. If you remove it, it's going to give you 8,800,000 naira bank balances. And he said he's going to pay his loan by himself. Now, this is the implication of this loan. Since you are paying your loan by yourself, it means that you are increasing your own capital. In some words, you are increasing your own current account. So this amount will actually increase his own worth of capital because he's using his own personal money. He's not paying it from the bank, not from the cash. So he's using his personal money to pay this loan of 20,000 naira. And if he's using it, then he's investing another additional 20,000 naira into the business. Premises for Buluke remains at 40,000 naira. Office equipment has increased to 23,000 naira because of the 3,000 naira office additional equipment. Inventory remains the same as 2 million naira. Receivables remains the same as 20 million naira. Bank has reduced to 8,800,000, and we have our cash remains at 9,500,000. With this was the reason why they arrive at these figures. Now, if you look at the workings, it should be very easy. Now, we open our capital accounts. The 80,300 balance brought forward, you can find that in this place, and the 50 million. You can find that we have loan capitalized of 20 million. That's loan that is now capitalized as 20 million. And we have a revaluation gain of 5 million from Yerima after increasing his assets and paying back some bad debt and his own and his what have you, and office equipment. So he has an excess of 5,000 naira. So the addition of everything will give you 55,103,300 naira, which is this. So what are the document contains in partnership agreement? We have your capital, your profit sharing, your interest on capital and drawings, your interest on loan, whether the current account to bear interest or not, whether partners, the limit amount of partnership drawings, methods at which they want to be valuing their assets, how to determine a new auditors, and so on and so forth. There's so much. So we also have another illustration, Ade, Olu, and Kola illustration. Can we look into this? Okay. Sorry. Adeolu and Kola are in partnership sharing profits of 321 respectively on March 31st, 2016. Their statement of financial position showed this amount. On 1st April 1st, 2016, Ade retired and the following terms were agreed according to their partnership deed. Goodwill was valued at 1.572 million and was not to be retained in the books of the continuing partners. Olu and Kola agreed to continue profit sharing ratio of 2:1, respectively. The main and to maintain their current accounts. Ade should take a car with carrying amount of 456,000 at a valuation of 324. Ade should receive a cash of 405,000 and retain the balance in a loan account bearing at 12% per annum. Prepare capital account, cash account, and loan account for the books of the old partners, and prepare statement of financial position for April 1st, 2016, after giving effect of retirement. So let's look at it. Ade, Olu, and Kola realization account. So Ade's has a partner capital account of 324, and he has a vehicle of 456,000. So what is the realization on this capital? So the realization, because this realization account is just for all of them. So we have a realization loss on realization from Ade, Olu, and Kola with their profit sharing ratio. What is their profit sharing ratio again? The profit sharing ratio is 3:1. So the difference between 3:4 and 456 is what they are actually sharing. Then we move to partner's current account. Balance BD, capital account. Balance BD is what is in their capital. 1511826 and 578. We can find them from the question, what is their capital? This is it here. So that was how they got their capital. Current account is also from the question. 1008, I think, is only Ade that has current account. Okay, because Ade is leaving, so that is why we are bringing in his current account here, because he's going to have access to every other of his accounts, current account. And we have goodwill 786524 and 4262. So your current account is actually depicted from, here, your goodwill. Goodwill is using the same sharing profit ratio of 3:1. So that was how we arrived at our goodwill here. Remember our loss of realization that we calculated here, 66, 44, 22. This is 44, 22. Who take over the car? I did take over the car worth of 324. Goodwill written off. Remember, we are not supposed to maintain the goodwill. So the amount should be shared between these two people. The beauty amount should be shared between them using their ratio 1:2 because they don't want to maintain it. Cash account 405. It literally means that Ade, remember, from the question, should go home with 405. The balance, if you have any, should be charged on interest rate of 12%, which is this amount. So basically, how do we get 2,510 naira? Is that we added this first three, we less it from Ade's account, it gave us 2510, and we start having 12% on it. So that was how we arrived at our answer. So we have cash accounts. Remember, from our 550, Ade was paid 405. Our closing balance is 145. Our loan account is now 795. How did you get 795? What is 12% of 2510? 0.12 times 2510. Oh, that is not it. 795. Or do you have loan in the question itself? And the balance in the account bearing per annum, say a 12% per annum. So what is the balance again per annum? This is it. And we have 795. How do they get 795? Is this supposed to be a typo? Capital account Ade. This is not supposed to be 795. Sorry, it's supposed to be 2,510 naira here. This is supposed to be 2,510 naira here. This is a mistake. It should be 2,510 because this is the difference between our realization card taking and goodwill for a cash account from Ade's account. So this place will be 2,510 naira. And you see later in the case where you see the figure. So your non-current assets, we have it already. Our motor vehicle, remember, is 907, but we've deducted 456 worth of vehicle because we have given it to Ade, and we have 451 left. Inventory, we have our figure, right? By adding them together, and we have total assets. Our capital now remains for Olu now is 258 and 294 worth of capital. Then we have for current account 551 and 386, 551 and 386 from the question, 551 and 386 from the question. And we have the loan. Remember that loan from Adi that I said 2,510. So that was what was supposed to be here, 2,510. This is it, that we have 850. Then our account is balance. So that is that for partnership accounts. That is the worst case scenario you can see in our partnership accounts. If you have any question with this extra little time that we have, you can let me know. And if you don't have now, maybe you can go back to the material, check towards it again, and if you have any question, you can just drop it on the group page, and we will always be available to answer you promptly. And if there is none for now, we can say good night. Thank you very much.